Refinancing your home mortgage isn't just about chasing a lower rate. Most people don't realize it's actually a financial reset button that can completely reshape your long-term wealth, cash flow, and exposure to economic risk. And the truth is, the biggest mistake homeowners make is assuming refinancing is always a smart move. It isn't. In today's market, refinancing is only beneficial under very specific conditions that most people don't even check before signing the paperwork. If you're watching this right now, pay close attention, because what I'm about to explain will determine whether refinancing will save you tens of thousands of dollars or quietly drain your finances for the next decade. And before we continue, don't forget to subscribe, watch till the end, and tell me in the comments whether you think refinancing is still worth it in today's economy. Your opinion matters more than you think. Most homeowners assume refinancing is simply swapping a high rate for a lower one. But the real mechanics behind refinancing go deeper. When you refinance, your loan resets to month one, meaning your amortization resets completely. Even if you've paid down 10 or 15 years in your current mortgage, refinancing starts the interest clock all over again. This is why banks love refinances. It puts you back at the beginning of the interest curve, where they collect the most profit. What most people never knew is that even a small rate reduction can end up costing them more over time if the new loan term is longer or if closing costs aren't fully accounted for. And speaking of closing costs, lenders often bury fees under different names: origination fees, underwriting fees, processing fees, title fees, appraisal fees, discount points, and even junk fees that have no real purpose. This is why many refinances that look good on paper are actually traps designed to increase lender revenue while giving homeowners only the illusion of savings. Here's another truth most people never hear. Refinancing only makes financial sense when the long-term savings outweigh both the total fees and the interest reset. A rate drop of 1% may not be enough, especially if you're far into your loan term. That's where the break-even calculation matters. To determine if refinancing is worth it, you have to calculate how long it will take for your monthly savings to recover your upfront costs. If the break-even period is longer than the number of years you realistically plan to stay in the home, the refinance is a loss. And yes, homeowners lose money all the time because they refinance without doing the simple math. Even worse, many refinance into 30-year loans even if they only have 17 or 18 years left, extending their mortgage into retirement without realizing it. Lenders won't tell you that. Brokers won't tell you that. But that's the truth. The next thing most homeowners never think about is the type of refinance. Rate and term refinances, cash-out refinances, and streamline refinances all function differently, and each carries its own risks. Cash-out refinances in particular are where many people destroy their home equity without realizing the long-term trade-off. Sure, taking cash out might feel like free money, but you're converting equity into debt that now accrues interest. And if property values decline, cash-out borrowers are the first ones underwater. This is exactly what happened in the 2006 to 2008 housing cycle. Millions used their homes as ATMs, then lost everything when prices dropped. The same pattern is quietly forming again in certain markets today. People are taking equity out to consolidate debt, fund renovations, or cover rising living expenses without understanding that they're increasing risk exposure at the worst possible time. And here's the part almost nobody knows. Your credit score, debt-to-income ratio, loan-to-value ratio, and even your employment history directly determine your refinance rate. Lenders don't advertise this, but borrowers with even a small credit drop can be charged dramatically higher rates. A single missed payment, a newly opened credit line, or even a temporary spike in credit utilization can wipe out thousands of dollars in potential refinance savings. That's how sensitive underwriting algorithms are, and it gets deeper. Interest rates on refinances often priced differently than purchase loans because investors treat refinanced mortgages as lower quality securities if they're frequently churned. If you refinance too often, you may get penalized quietly without even knowing. Finally, you need to understand the macro forces at play. Mortgage refinance rates are tied to the bond market, specifically the yield on the 10-year Treasury and demand for mortgage-backed securities. When investors demand more return, mortgage rates rise. When global uncertainty pushes investors into safe assets, rates fall. The Federal Reserve influences this indirectly through policy, but it does not control refinancing rates outright. So if you're waiting for rates to go back to 3%, you're likely waiting for something that may not happen again in our lifetime. The ultra-low rates of 2020 to 2021 were caused by a once-in-a-century economic shutdown, trillion-dollar liquidity injections, and emergency monetary policy. Without those conditions, those rates aren't coming back. That's why anyone thinking about refinancing today needs to approach it strategically, not emotionally. So you're thinking about refinancing your mortgage? Everyone talks about it like it's a magic button to save money, but the truth is, it can be a financial trap if you don't know what you're doing. Today, we're going to break down when refinancing actually makes sense and when you should avoid it completely. This isn't just about a lower payment, it's about making a smart financial move that builds your wealth, not just the bank's. Let's start with the absolute basics. A refinance is a tool, not a solution. The most common reason people refi is to get a lower interest rate. If your current rate is significantly higher than what the market is offering today, it's worth a look. For example, if you're paying 7% on your mortgage and rates drop to 5.5% or even 5%, you could see a huge drop in your monthly payment. Sounds great, right? But here's the catch. The math has to work. Refinancing isn't free. You have closing costs, things like appraisal fees, title insurance, and lender fees that can add up to thousands of dollars. Let's say those costs are $8,000 and your new lower payment saves you $150 a month. To figure out your break-even point, you divide the costs by the savings. In this case, it would take you over 4 years just to get back the money you spent on the refinance. If you plan to sell your home before then, you've actually lost money. This is a critical point that so many people miss. They get lured in by the promise of a lower monthly payment, but they don't calculate the break-even point. If you're not planning to stay in your home long enough to recoup the costs, the refinance is a bad deal. You're just giving money to the bank for no long-term benefit. Another trap is resetting your loan term. Let's say you're 10 years into a 30-year mortgage. When you refinance, most people just roll into a brand new 30-year loan. Sure, your monthly payment drops, but you've just stretched your debt out for another 30 years. You're back to square one, paying mostly interest for the first several years. Over the full term of the new loan, you could end up paying tens of thousands of dollars more in total interest than if you had just stuck with your original mortgage. The bank loves this because they get to collect interest from you for a much longer period. Now let's talk about your financial timeline, because this is huge. If you are approaching retirement, refinancing into a fresh 30-year loan is almost always a terrible idea. Think about it. You might be in your late 50s, hoping to be mortgage-free in a decade. A new 30-year loan pushes your final payment into your late 80s. That's a recipe for financial stress in your golden years. In this scenario, a 15-year refinance might make sense if you can afford the higher payment because it gets you out of debt faster. Or maybe the best move is to not refinance at all and just focus on paying down your current loan. On the flip side, if you're young, you just bought your forever home and you know you'll be there for the next 15 or 20 years, refinancing can be incredibly powerful. If there's a big enough drop in interest rates, locking in that lower rate for the long haul can save you an enormous amount in interest costs. You'll build equity faster and free up cash flow for other investments. The key is having a long-term plan. Most homeowners don't think this far ahead. They just see the immediate monthly savings, not the total cost over 3 decades. Okay, let's get into the riskiest type of refinance, the cash-out refi. This is where you refinance for more than you currently owe and take the difference in cash. People use this money for all sorts of things: home renovations, paying off credit cards, buying a car. It can be a smart move in very specific situations. For example, if you're using the cash for a kitchen remodel that will significantly increase your home's value, that can be a good investment. Or if you're consolidating high-interest debt, like credit cards with 25% APR, into a mortgage with a 6% rate, the math can work in your favor. But here's the danger. A cash-out refinance turns your home into an ATM, and that is a very risky game to play. Every dollar you pull out is debt that is now secured by your house. If you can't make your payments, you could lose your home. The real danger comes when the housing market cools down. We saw this happen recently. Between 2021 and early 2022, home values were soaring. People were pulling out massive amounts of equity. Then, interest rates shot up and the market slowed. Suddenly, those people were left with a higher mortgage payment, less equity, and a home they couldn't easily sell without taking a loss. They had wiped out their financial buffer. This is especially dangerous in volatile markets. Think about states like Florida, Texas, or parts of California, where insurance costs and property taxes are skyrocketing. A cash-out refi in those areas amplifies your risk dramatically. You're increasing your debt on an asset that's becoming more expensive to own each year. That's the dark side of refinancing that nobody talks about. It's not free money, it's debt with serious consequences. Now let's talk about something that can quietly make or break your refinance, your credit score. Most people think if they have a 740 score, they're golden and will get the best possible rate. That's not always true. Lenders use a system of pricing tiers, and these tiers can be very sensitive. A score of 759 might get you one rate, but a score of 760 might unlock a better one. Even a small difference in your score can change your interest rate, which adds up to thousands of dollars over the life of the loan. Things like high credit card balances, old collection accounts you forgot about, or even too many recent credit applications can knock your score down just enough to put you in a more expensive tier. This is why the smartest homeowners spend 30 to 60 days prepping their credit before they even apply for a refinance. They pay down their credit card balances to get their utilization ratio below 30%. They dispute any errors on their credit report, and they avoid opening any new accounts. Lenders won't tell you to do this. Why would they? A slightly higher interest rate for you means more profit for them. So take control. Polish your credit before you let any lender pull it. Let's tackle one of the biggest myths out there. I'll just wait to refinance until rates drop again. Homeowners say this all the time, thinking they can perfectly time the market. Here's the reality. Timing the refinance market is just as hard as timing the stock market. It's basically impossible. Interest rates don't just move slowly and predictably. They can swing wildly in a single day based on all sorts of economic news. Things like inflation reports, jobs data, Federal Reserve announcements, and even global events can cause mortgage rates to jump or fall. If you're waiting for that perfect rate you saw 6 months ago, you might be waiting forever. You could miss a great opportunity right now because you're holding out for a fantasy number that may never return. The smarter approach is to stop trying to predict the future. Instead, monitor the market and understand what drives rates. When the numbers make sense for your personal financial situation, that's the time to act. Don't let the perfect be the enemy of the good. Finally, let's talk about the psychology of refinancing. Lenders are masters at selling you on the idea of a lower monthly payment. It feels like such a relief, right? But that feeling can blind you to the long-term reality. A lower payment that comes from stretching your loan out for 30 more years isn't a win. It's a trick that locks you into paying more interest over time. This is how lenders make billions of dollars. Instead of just chasing the lowest payment, think about what loan term aligns with your goals. Maybe you can handle the payment on a 20-year or even a 15-year loan. Yes, the monthly payment will be higher than a 30-year, but you will be out of debt a decade sooner and save an incredible amount of money on interest. You'll build equity so much faster. A shorter loan term is one of the most powerful wealth-building tools a homeowner has, but you have to be sure your income is stable enough to support it. So, how do you make the right call? It all comes down to one simple question. Does this refinance put me in a stronger financial position 5 years from now? Forget the short-term relief. Think about the long-term impact. Will you have more equity? Will you be closer to paying off your home? Will you have saved a significant amount in total interest? If the answer is yes, and you've done the math to prove it, then refinancing can be one of the best financial moves you ever make. But if the answer is no, or you're just doing it to get a little extra cash each month, then walk away. Your future self will thank you. Thanks for watching. If you found this helpful, make sure to like and subscribe for more straightforward financial advice. See you next time.